Hey, what's going on everyone? Matthew from therighttrader.com here. Today I'm going to be going over how to trade 3 times leverage ETFs. Everything I say in this video will also be relevant for 2 times leverage ETFs, which are a little bit less popular, but you know they exist. And yeah, I'm just kind of going to guide you through the different facets of these 3 times ETFs that are obviously pretty popular, but quite risky. And I'm going to go over some pros and cons, just going over the advantages and disadvantages of trading these ETFs. And then I'm going to go into some of the details of actually trading them. I'm going to give you some tips and tricks. And yeah, I will mention that I'm going to be basing myself off an article that I wrote a couple months ago. So if you want to actually read the article, I'll put a link in the description below. And I am going to be going into a little bit more detail in this video, actually showing you some of the graphs and stuff so you get a better understanding. So yeah, just stay tuned for that. And I will mention that obviously, like I said, these 3 times ETFs are pretty risky, and you probably shouldn't be trading these if you don't have the correct skill set, meaning technical analysis skills, the ability to day trade. So yeah, I just wanted you to be aware of that. That's obviously just my opinion, but yeah, I'm gonna touch on that in a bit more in a bit. But yeah, we're gonna move on to some of the pros of trading 3 times ETFs. So first off, we have leveraged gains without the need for a margin account. Okay, so this is actually a pretty big positive here. You basically get to receive these leveraged gains and returns without risking more than you really have to, which I think is really good because you don't have to go through the hassle of getting a margin account, getting approved, and actually putting up that extra risk on the table when you can get these leveraged gains, probably I guess you could say even better gains with less risk, right? So this is a pretty big advantage, obviously, for people who are into to short selling and things like that, right? So like I said, usually people have a margin account to short sell stocks, for example, and the problem with that is yeah, there's no other way to short really unless you have a margin account. But with these, you can get to sort of short stocks in a way without really shorting them. And what I mean by that is if you look, for example, here, I just pulled up a random 3 times ETF, right? This is a pretty popular one. It's the 3 times inverse natural gas ETF called DGAS. And basically, if natural gas goes down, let's say 1%, this ETF should go up about 3%, right? So that's sort of the logic behind that. And that's why I say you can kind of short without really shorting. So yeah, that's a pretty big positive right there. Okay, so moving on, we have compounding gains, and what I mean by that is since these 3 times ETFs do go up quite a bit or down, you know, that's obviously the risk. Is that these 3 times ETFs can easily go up 5, 10, 15% in a day, and even do that in a couple days in a row. So that's obviously really powerful, right? Because you're going to be compounding day after day all your gains, right? So if you start, let's say, with $10,000 in it and it goes up 10%, you're going to have $11,000 the next day, and that's going to compound quickly, okay? So you're going to be in a nice position if you're able to catch sort of consecutive days where the stock isn't too volatile and is moving to the upside, okay? But obviously you have to have sort of a perfect timing for that to happen. But it can happen if you know what you're doing. And I guess it does happen sometimes. So yeah, that is one of the advantages. You will see pretty significant returns really fast if that happens. Next up, we have sort of the less risk exposure of these. So this kind of goes hand in hand with what I said with the fact that you don't need a margin account. But what's interesting is you also, for example, don't have to go through trading stock options, right, to get your leveraged returns, okay? And that's also a pretty big positive because with stock options, obviously, you're going to be risking probably most, if not all, of your investment. And if that's something you want to avoid, obviously, you still can take a big loss with these ETFs, but you probably will minimize your risk a bit compared to actual stock options. Okay, so yeah, there are some sort of risk reducing aspects of these ETFs, but I mean, they are overall pretty risky, so yeah, you should be aware of that, okay? Next, moving on to the cons of trading 3 times ETFs. So here we're going to start off with the large losses that can compound fast, okay? So like I said before, we have our compounding gains, right? But we also have our large losses that can compound really quickly as well, okay? So the stock, it keeps going down for multiple days in a row with volatility, you're going to take a hit, okay? Because what I'm going to mention now is also pretty big downside of these 3 times ETFs. Probably the biggest downside is decay, okay? You probably heard about 3 times ETF time decay. And what this means is that over time, right, you probably won't see much of this if you're just holding the ETF for a couple days, But if you're holding it for multiple days, multiple weeks, and then multiple months especially, right, you're going to start to take a massive hit because of decay. And it's a pretty complicated thing to explain because there's multiple factors, and it's not really that easy to understand. It gets pretty confusing, but there's factors like contango, which you can go ahead and look into if you want to get a better understanding of this. But there's also fees and re-equilibration that happens, which will actually make you take a little bit of a loss each day that goes by, I guess, in simple terms. But a good way to see this, right, really happen is I put up a picture here of Nugget, right? This is a 3 times gold miners bullish ETF. So if the gold miners that this ETF invested in go up, it does 3 times the movement of those. And obviously, these gold miners haven't gone down 99.7%, right, since this ETF started. I'm not sure what they did, but they definitely didn't go down like this, okay? Probably some of them went up, some of them might have gone down, some of them up. But basically what happens with these ETFs is that they just always sort of approach zero, right, which is really bad because what happens is, I'll get into this in a bit, but they have to reverse split to keep the ETF running, sort of. So, how can I explain this? If you're actually wanting to invest in these ETFs, it's not a good idea because these are really not what these ETFs are made for, right? They're meant for trading and reactionary tools to events, I guess you could say, and stuff like that. Definitely not investing long term. It will not work because they will always move to the downsides, with the exception of some like SPXL. I can pull that up real fast now, but let me just show you also. For example, on this one, I'm sure it's the same thing. If we look, 91% loss since inception right here. So yeah, as you can see, they always will approach zero, and if you're trying to bet on it just going upwards like a normal stock, right, over long term, you will lose, pretty much guaranteed. So let me show you also, like I said, with sort of an example where you may be actually to hold it for a bit longer periods of time, but if there's any kind of volatility, you're also going to take a hit on decay. It would be a 3 times ETF like this, which is the S&P 500 3 times ETF. And obviously, since the S&P 500 is, I guess you could say, kind of stable and normally moves to the upside, right? It has been moving towards the upside consistently. You can actually get some nice compounded gains, okay? But yeah, it's still have to be aware of decay and how that affects your holdings, okay? So I hope you got a good idea of that, because it's really important to understand that, because it is the big risk of these 3 times ETFs. So next, I do want to say, like I mentioned, that experience is really going to be key for success when trading these 3 times ETFs. And what I mean by that is you have to be on point with pretty much the following aspects. Technical analysis, you really have to know what you're doing. There's really no leeway with these 3 times ETFs. You actually have to sort of be a professional when it comes to this stuff, right? You really have to know what you're doing. You have to have fast timing and execution on your trades. You have to have proper risk management. Otherwise, you're really gonna get hurt badly, right? And stuff like that. So be careful with that, and you really probably shouldn't be trading these unless you actually are an experienced day trader. Okay, so going back to what I mentioned before, the reverse splits, right? This is also a pretty dangerous downside. And of these 3 times ETFs is, like I said, since they always move downwards and they approach zero, right? What you'll see happen is that some of these will, let me see here, I think I pulled one up just before. They slowly move, they'll slowly reach and try to move towards zero, and they usually get down to sort of single-digit range, right? A couple dollars, $3-4, and then they'll actually experience a reverse split, which puts the price back up higher by tinkering with the amount of shares, and what will happen is you'll lose a significant amount of your investment, right, depending on how much the split is. So be careful of that. You can also research this to get in some more detail on how reverse splits work, okay? But do be aware that they're very common, very common with these 3 times ETFs, and they happen again and again and again, especially when the ETF is in the lower digit range, right? Single digits, like I said, that's usually when it happens, right? Usually under maybe $5. But it can really happen at any time if the ETF is doing badly, especially. So next up, the ETF tips and tricks section that I'm going to go over. So first of all, I want to say you should probably use a stop loss, right, to prevent large losses, because these triple ETFs move so quickly that if you don't have an actual stop loss ready, you're not going to be able to get out when you want to, and you might get caught in a bad situation. So yeah, use a stop loss, and yeah, you'll definitely reduce your risk with that. Next up, when trading these ETFs, make sure to use limit orders because, like I said, they move so quickly that if you don't use limit orders and you just send in a normal market order when buying or selling the ETF, you might get a significantly different price than what you were looking at just seconds ago, okay? Because they can move really quickly, like 1% in just a couple seconds, okay? So be careful with that, and that's easily avoidable with limit orders, okay? So next up, we have, like I mentioned before, avoiding to trade these when the price is low, just because you might get caught when there's a reverse split, and you don't want that to happen. So better be safe than sorry, right? And plus, when the price is low, the movement on these ETFs gets kind of weird. So yeah, it's just all around probably not a good idea. Next up, this is also a really important one, is always do your technical analysis and fundamental analysis on the underlying derivative, not the leveraged ETF itself, okay? And what I mean by that is, if you're going to be trading, for example, UGAS, right? The 3 times long natural gas ETFs, you don't want to be doing your technical analysis on this actual ETF, okay? You want to be doing it on the actual natural gas price, because if you're doing it on the ETF, you're actually not doing it on what the ETF is based on, okay? You really have to do it on what the ETF is based on, which is the price of natural gas in this case, because that's actually what it's trying to track and where the movement is happening, okay? So the ETF has a bunch of jumps and stuff, and the price action is different, so it's not the right way to do your technical analysis if you're doing it on the actual ETF, okay? That's sort of a little pro tip, I guess you can say. Always do, never try to predict moves or bet that something will happen with these 3 times ETFs, because they're really meant to be reactionary tools. And I'm not gonna lie, I did get burned before by trying to sort of like predict a movement, but it's really not the way to go about trading. And especially with these, you're gonna take on some massive risk if you try to predict a move and take a bet, and it's just not gonna be worth the risk in most cases. So you really want to trade these as an actual reactionary tool. And so what I mean by that is, let's say you see that there's a breakout that happens in natural gas, then maybe you could take a long position on the actual ETF, right? So yeah, there's an example of how you could trade these ETFs. Next up, just re-mentioning that probably shouldn't be trading these for more than a couple of days, right? And a lot of people actually only day trade these, right? So at the end of the day, they'll never keep their position in these ETFs. So yeah, be aware of that. And like I said, finally, make sure you know how to day trade before getting into these if you want your best chances of success. But all of this is just my opinion. It's not financial advice. So yeah, trade and invest at your own risk, guys. But I wish you the best of luck. I hope you liked this video. And make sure to subscribe for more. I have a lot more videos coming. And yeah, thanks for watching. Have a good day.